Anglo American shares rose 5% to 3,703 pence after the miners slashed its copper unit cost guidance by roughly 15%, down to around 145 cents a pound. The rally reads as a straightforward win, but the same copper price move behind it just tripled the quarterly earnings of peer TECK Resources, and Anglo's own production barely moved at all. Anglo's copper production came in at 173,200 tons, essentially flat, with higher throughput at Los Bronces offsetting weaker grades at Collahuasi and Quellaveco. Full-year guidance was left unchanged across every division. That raises the immediate question of where exactly this rally is actually coming from, since it clearly is not coming from more copper leaving the ground. Anglo's realized copper price came in at 608 cents a pound, up 39% year-on-year, and above the average London Metal Exchange price. UBS retained its buy rating and a 4,600 pence price target on the back of that margin story, treating the cost discipline as the reason to stay bullish into Thursday's interim results. But that same UBS note warned that first-half group EBITDA could undershoot the $3.9 billion consensus, with its own analyst forecasting $3.6 billion instead. One house is simultaneously defending the target price on cost discipline and flagging that the group-level number due this week may come in short. That is not analytical noise. That is the same broker holding two positions on the same set of facts.
TECK Resources, competing for the identical copper tailwind, realized $6.09 a pound versus $4.36 a year earlier, and posted adjusted earnings per share up 415% to $1.39, comfortably beating estimates of 78 cents. The commodity move is the same one lifting Anglo shares today, yet it shows up in TECK's results as an earnings explosion rather than a cost guidance footnote. The difference is not the copper price, it is what each company did with it. TECK's copper output climbed 25% quarter-on-quarter, so higher volume met a higher price and multiplied straight through to profit. Anglo's output stayed flat, so the same price rise could only show up as a lower per unit cost, a much smaller lever on the bottom line than TECK's volume surge produced. Meanwhile, the businesses Anglo is trying to exit are actively working against the copper story. De Beers and steelmaking coal are both expected to have been EBITDA negative in the first half, with rough diamond prices down 32% to $105 a carat, as lab-grown stones keep eroding demand. Anglo did agree to sell its Australian coal assets to Dilmar for up to $3.88 billion, but that deal has not closed yet, so those losses are still sitting on the books this quarter. That is the buried assumption behind today's rally. Investors are pricing the cost cut as if it were a production win, when it is really a margin defense against a group that still has two EBITDA negative businesses attached to it. The cost cut makes each pound of copper more profitable. It does not make Anglo produce more of it, and it does nothing to offset what De Beers and coal are still subtracting.
Anglo American reports interim results this Thursday, and that print is the checkpoint that actually decides which read was right. The consensus band sits between $3.6 and $3.9 billion in first-half EBITDA, with UBS's own house forecast sitting at the low end of that range, despite its buy rating and 4,600 pence target. If Thursday's EBITDA prints above the $3.9 billion consensus, the cost cut converts into a confirmed group-level win, and today's 5% move holds up as the start of a re-rating. If the number lands at or below UBS's own $3.6 billion forecast, the rally gets exposed as having run ahead of a group result still weighed down by De Beers and coal. The TECK merger timeline is the second variable riding on this same print, with completion still targeted between September 2026 and March 2027, and Chinese antitrust clearance the last outstanding hurdle. A holder should watch whether Thursday's EBITDA clears UBS's own 3.6 floor before deciding whether to trim into this week's strength, and a watcher should treat that same number, not the cost cut headline, as the entry signal one way or the other.